Hey everyone, welcome back to the Kuderna podcast. I'm your host, Bryan Kuderna. So, for any new listeners out there, again, when I'm talking, it's about personal finance and economics. When we have some guests here on the show, we're talking about everything else that I'm perhaps not so qualified to speak on. But today's episode, we are going to focus on the bedrock of American retirement planning, and that would be Social Security. So, if you're not familiar with how the system works, we'll get into some of the nitty gritty today. And the overall emphasis of today's episode is going to be how Social Security gets taxed. Many people are not familiar with this. It's not something that's talked a lot about or explained. A lot of folks, they don't understand it until they actually get there. And they say, hey, why am I being taxed or not taxed on this certain portion of my retirement income? So today what we're going to do is uncover exactly how Social Security benefits do get taxed. Again, focusing on retirees in particular. And then we'll finish up with some different strategies or tips on how you could mitigate those taxes, because I know everybody out there, myself included, cannot stand paying taxes. So before we dive into some of the details here, let's just talk about what exactly is Social Security. So this is the foundation today of American retirement planning. All right, it was signed into law into 1935 by FDR. All right, so it's been with us for quite some time now. If you do the math there, that's what's it going to be, about 90 years. Okay. And Social Security first kind of came into existence 2 years thereafter in 1937. That's when Social Security taxes began being collected. And it's also when the first benefits began to be paid out. All right, so it's an enormous program. All right, as I'm going to get into in a moment, it is the second biggest line item on the US federal budget. It is huge. And it's something that is going through a bit of a transition right now. If you're into economics, you're probably seeing this front and center. If you're not, it's something that I don't think gets enough attention that it deserves for the general public. And the reason for that is there's a lot of issues. I don't want to say problems, but there's a lot of issues with the Social Security system right now. And politically, it's just not popular to address what might be those solutions, because any way you slice it, these solutions are going to bring about a little bit of pain with them. So naturally, politicians in charge that want to get reelected, they say, you know what, why don't I just kind of skirt around this issue and let the next person to be elected deal with it and kick that can. All right, so roundabout way of introducing today's topic, taxation of Social Security. Let's get right underway.
Is going to require work and time and sweat and toil.
If money wasn't an issue, what would I be doing?
Don't worry about it. You'll figure it out.
Change is the only constant.
The Kuderna Podcast.
Okay, so like I said, Social Security, this huge foundation of American retirement planning, exactly how big is it? According to the Social Security Administration, this year in 2025, an average of 69 million Americans per month will receive a Social Security benefit. All right, that's totaling about $1.6 trillion of benefits paid in this year alone. Of those 69 million beneficiaries, the overwhelming majority, about 52 million, are retired workers collecting their supplemental Social Security retirement income. All right, there are another 7.2 million that are disabled workers, and the rest are dependents or survivors. Okay, so as you can tell, the overwhelming majority, this is something geared towards retirement, with about 52 million American retired workers collecting benefits. The average monthly benefit in retirement, a lot of people get surprised by this. It is not chump change. The average monthly retirement benefit today is $1,931. I'll repeat that, $1,931 a month is the average retirement benefit. And therefore, Social Security represents about 31% of the income for people aged over 65. All right, so about a third of retiree income we're seeing come directly from Social Security. And that, of course, makes it the largest source of retiree income today. All right, and just to kind of round out that picture, Social Security is number one. Defined benefit pensions would be number two. And then defined contribution plans would be number three. That's going to be your IRAs, 401ks, 403bs, TSPs, on and on. Some of these workplace retirement plans that have grown more popular over the past 20 or 30 years. Okay. So we already know it's a big system that goes without saying. And let's get into exactly how it gets funded and how the system operates. All right. So if we open up the hood, Social Security is simply an equation. It's based on inflows and outflows. All right. I won't get into all the metrics of how those benefits get calculated, again, which is based on how many quarters you work here in America and pay FICA tax, which I'll touch on a little bit. And then also when you want to collect your benefits. Okay. Normally, age 62 is the earliest that you could collect your retirement benefit. As of right now, for most folks out there that are retiring, their normal retirement age, the NRA, which is when they can collect their full benefit, is about age 67. Okay. And then the furthest you could defer it, if you want to let that benefit keep on growing, that would be age 70. All right. At age 70, you have to collect your retirement benefit. There's no further growth. There's nothing left to do at that point. That's the longest that you could defer. Okay. So I know that was a little bit of a teaser on the outflows, the actual benefit side of the equation, but let's spend a little bit of time talking about the inflows first. Okay. So like I alluded to in my intro, Social Security is the second largest line item on the US budget. It's about $1.5 trillion annually. Okay. That number one, the only thing bigger right now would be Medicare, Medicaid. Okay. And it wasn't always that way. Social Security for many years was number one. But with healthcare growing the way it has, and same kind of conundrum we're running into of folks aging, living longer, a lot of added expenses that go along with that. You see Medicare, Medicaid totals about $1.7 trillion a year on the budget. All right. And then those numbers, those are ahead of the third biggest expense. This is the one that I'm really trying to kind of raise attention to. I talk a lot about it in my book, What Should I Do with My Money? Which you could probably see behind me if you're watching this live. The third biggest expense on the US budget is the net interest on debt. Okay. Our federal government is spending just over $1 trillion a year just to service the debt that we carry as a country, which is a huge number. That's about $36 trillion today of national debt. You should keep in mind now, we want to be safe. We want to be a safe country. A lot of people, especially around the world, they look at America and say, oh, they spend the most on defense and arms and war and all this stuff. That must be our biggest expense every year. It's not. It's actually number 4. Okay. Right now, the US government spends about $896 billion on the Department of Defense. Okay. So I think that's a little alarming that we spend more money just servicing debt, just paying out interest every year than we do on US defense and keeping our country safe. Okay. But again, those two are quite a bit behind Social Security and then Medicare, Medicaid. Okay. So where did Social Security come about? Like I mentioned, FDR signed it into law with the Social Security Act in 1935. And going back to what are the inflows? How do we actually fund this system? Where's all the money come from? The answer is most of that money comes from us, the workers, okay? In 1940, all right, so you think about Social Security at this point is just getting going, all right? They've only been collecting and paying for about 3 years now. In 1940, the ratio of Social Security covered workers versus beneficiaries collecting benefits, okay, so inflows into the system and outflows of benefits being paid, that ratio was 159 to 1. All right, I'll repeat that. In 1940, there were 159 covered Social Security workers, which meant that you were at work paying Social Security tax for every one beneficiary. Okay. So if you just do the math there, this, obviously sounds very feasible. we've got a lot of people putting into the system, 159, for every one that's out there collecting benefits. Okay. And furthermore, when the program started, the normal retirement age was 65. Okay. And if you think about in 1940, what was life expectancy? Obviously, it wasn't quite as long as it is today in 2025. So what is the trend that we've been realizing? 1940, again, ratio of 159 to 1. In 1950, we fast forward another 10 years, there were now 17 Social Security covered workers paying tax for every one beneficiary. Okay, so we start to see a big, quick change there, obviously. In 1960, that ratio drops 5 to 1, 5 tax-paying workers per each beneficiary. And then we get to where we are today in 2025, and that ratio is about 2.7 to 1. Okay. So if we just look at the simple math, the population dynamics here, you could see that the inflows and outflows are starting to change. They're starting to get a little bit out of balance. So like I mentioned, Social Security covered workers. What does that mean? All right. Social Security gets funded by what's called your FICA tax. That's the Federal Insurance Contributions Act. All right. Your FICA tax, which is composed of quote unquote the old age survivors and disability insurance taxes, which are collectively known as Social Security tax. That's what most of us recognize it as. The Social Security tax is 6.2% on the employer, okay, and 6.2% assessed to the employee for a grand total of 12.4% of income. All right, so of the income that these folks are earning, which is pretty much everybody, aside from some niche cases of federal workers and things, but pretty much everybody out there that's working and paying taxes in America, about 12.4% of their income is being taxed and going to the Social Security system. Okay. And again, that's split evenly between the employer and then the employee. All right. Of that amount that gets taxed, there is a wage-based limit. All right. This is important to recognize. A lot of people, they see this in their paycheck, and then maybe halfway through the year or 3/4 through the year, like something happened here. Maybe I'm getting paid more. I don't get it. The reason that often happens is today in 2025, the wage-based limit is $176,100. What that means is that your income up to that amount gets taxed for Social Security. Once you hit that threshold, you no longer have to pay Social Security tax. Okay, so kind of a good thing and a bad thing. Good in the sense that it's like, hooray, we're not having to pay any more taxes on this for the rest of the year. The bad side is we're not making any more contributions to this program and generating what could possibly be a larger benefit when we retire. Okay, so that's why for a lot of people, let's say that you're on a salary making $250,000 a year, and then all of a sudden come August, September, October, you see your paycheck maybe go up a little bit. It's because you already hit the limit for that year, and they're no longer withholding that 6.2% of tax on your income. So those are two reasons. I get this question a lot as an advisor of why did my pay go up? Often it's because we've hit that income limit, that wage-based limit, or sometimes if we max out our 401k or our 403b plan, and once we hit the limit on that, okay, which is about 23,500 for folks under 50, once we hit that limit, there's no more withholding for it. Okay, so a lot of people, they may hit that limit around the same time of the year and notice a real boost in their paycheck for the duration of that calendar year. And that's the reason why. I know this is kind of dry information, but the numbers do tell the story here. Okay, so Social Security is meant to be a self-financing program. What does that mean? It means it essentially runs on its own. It's not meant to say, hey, we need to go borrow from over here and finance this and issue new bonds for a program and, kind of rob Peter to pay Paul sort of situation. It's supposed to be self-contained, and that the Social Security program collects those FICA taxes, all right, and then they invest them. Most of that money then does get invested. And then as people retire, they get paid out their benefit, which is essentially a return of their taxes paid plus whatever growth that those monies may have, accumulated over their entire career. So what does that actually look like? Again, if we really want to dive under the hood. All right, so about 91.3% of Social Security's revenues come from payroll tax contributions. They come from the FICA tax. All right, so that's about 91.3%. This is all according, guys, to the Social Security Administration. If you really want to kind of geek out on economics and stuff, you can just go to, Social Security's website and read up on all of this. All right, and then the difference, the remaining amount, all right, about 3.8% of Social Security revenues come from federal income taxes on the benefits paid. Okay, that's what we're going to get into in a little bit here. And then the remainder, the remaining about 5%, is interest earned on trust fund reserves. So what that means is, as Social Security for the past 90 years has been collecting all of this money, whatever was not paid out is sitting in a trust fund. And that trust fund gets invested very conservatively over time. And as of right now, that earns about 5% interest that goes back into the system. So what does that grand math look like over the duration of 90 years since we created the program? As of right now, Social Security has collected about $27.75 trillion of income. All right. I'll repeat that. The Social Security system has brought in about $27.75 trillion. The system has paid out in the form of benefits. They have paid out $24.96 trillion. Okay. So naturally, that leaves a remainder, a trust fund, of about $2.8 trillion today. That's the buffer. Those are the reserves within Social Security. Now, this is the key thing that you're going to start hearing more about if you have not already, is that it is projected, and this is right on Social Security's website. It's not a hidden fact. It is projected that those trust fund reserves will be completely depleted by 2035. Okay, which if we do in simple math, that is 10 years from today, there will be no buffer there. Okay, at which point, if nothing changes, tax revenues will be able to cover about 83% of benefits paid. Okay, so what that means at that point is that as Americans go to work and they pay their taxes, those Social Security taxes will immediately come in and go out the other door to beneficiaries, but they'll only be able to cover about 83% of the benefits that should be paid. All right, we could have a whole nother episode or many episodes on what are the solutions there to cover that shortfall, or possibly start rebuilding that trust fund reserve. All right, the easy things, the simple answers there, again, being that it's all about inflows and outflows, it's either A, raise taxes, or B, reduce benefits. And then any combination therein. So we'll see. We're going to see, over the next several years, especially over the next 10 years, what we're going to do about that looming problem there. Okay. So again, I mentioned that the title of this episode, we're talking about the taxation of Social Security benefits. I wanted to give you that kind of that foundational knowledge of Social Security, because otherwise, when you say, well, why are you taxing my benefits? This is why. Okay, there's a lot of math here. There's been a big evolution to this system over the past 90 years. And that's how we ended up having our Social Security benefits taxed. Okay. So a lot of people, they're not aware of that. I see this constantly with clients. They retire and they say, hey, my Social Security benefit, right about that average of say $1,900 a month, why are they withholding taxes? Or how come when I file my taxes in April, I owe money to Uncle Sam? I've been paying my entire career. This doesn't make sense. Okay. The reason that is for that confusion is for much of its history, Social Security benefits were not taxed. Okay. You received that entire benefit tax free. That all changed in 1984. Okay. And the reason being is that in 1983, there was the Social Security amendments, and that changed this. Okay. that said that a portion of your Social Security benefit could be taxable, and that came into effect again in 1984. What did that say? This is where I'll kind of slow down a little bit to explain some of the minutia. It is based on what's called your combined income. All right. Your combined income is your adjusted gross income plus any non-taxable interest plus half of your Social Security benefit. All right. So you want to look at those three numbers: your adjusted gross income, your non-taxable interest that you may have received, and half of your Social Security benefits that you receive. That's your quote unquote combined income. Now, if you're retired and you're filing jointly, if your combined income is under $32,000, you still get your Social Security benefits tax-free. Okay. If your combined income is between $32,000 and $44,000, half of your benefits will be taxable. Okay. Now, if your combined income is over $44,000, 85% of your benefits will be taxable. Again, that's all if you are married filing jointly. If you are a single filer, okay, it works the same exact way. It's just that those income thresholds are $25,000 and under, tax-free, $25,000 to $34,000, half of it's getting taxed. And then when the combined income's over $34,000, 85% of your benefits will be taxed. Okay. That is your Social Security benefit taxation in a nutshell. Okay. So yes, for a long time, from 1940 up until 1984, tax-free. Since that time, it used to be half of your benefits could be taxed. And then in 1993, they made another amendment in which 85% of your benefits could be taxed. Again, for folks that are making higher than that last threshold. Now, what's unique about this is, remember, everything I just described, this came about in 1983. These thresholds, the dollar amount has not changed. So what that means, naturally, we all experience inflation. Along with that, we've experienced, raises in income, naturally raises in that combined income figure. So every year, more and more people are being subject to this taxation because those thresholds have not been indexed. Okay. So why do they do that? I mean, that may sound unfair. Like, hey, that's just another way that they're getting more and more of us. It's exactly what it is. Okay. I mentioned a few moments ago the conundrum we're running into of inflows and outflows. If we tax, speaking of the US federal government, if we tax Social Security benefits, it's a way to recoup the money that we're paying out, obviously. Okay. So it's a bit of window dressing of saying, hey, we'll still continue your Social Security benefit, but we're going to take more and more of that back every year as more people get subject to that taxation. Okay. If we were to say what's going on right now, again, politically, sounds great. We're seeing the Trump administration say that they want to have no taxes on tips, which is, for restaurant workers and such. It's a separate issue. And no more income taxes on Social Security. All right. We've heard President Trump allude to this a couple of times now. And that could be something if they extend his tax cuts from his first term. It's a target for the administration later this year. They would like to fold in the removal of taxing Social Security benefits. That would be fantastic for retirees. That would be probably a boom for the economy and the stock market as we create more liquidity and more money flowing through the economy. That would be a bad thing for the Social Security system. That would just simply mean outflows are going on the track that we see, and we're cutting inflows yet again. So you always got to remember there's no free lunch. You're going to have pros and cons to each of these decisions. All right. So I hope that gave you kind of a general idea on how the benefits could get taxed and why they get taxed. And now what we're going to do is just give you a few tips on what you could do to plan ahead. Again, remember, timing is everything. If you have time on your side, you can plan for this. As you get closer and closer to retirement, or you are in retirement, naturally you don't have the same options as someone who's 30 years old and doing a lot of other planning for the next 30 plus years, right? So what are some of those strategies to consider? I'm going to rattle off a few here that we talk with clients about. Number one, this is particular for entrepreneurs and some investors out there. If you're anticipating a big one-time event, maybe you've built this company over the past 30 years and now you're going to sell it. You're going to sell it to your competitor or to your rising stars or what have you. What a lot of folks will want to do is structure an installment sale. So rather than saying, hey, I'm selling my company right now with the stroke of a pen for $3 million, what if we stagger those payments out over, say, a 5-year stretch? All right, that's very common. Sometimes it makes it easier for the buyer so they don't have to come up with that huge lump sum. But also tax-wise, that could be beneficial for the seller, the owner of the company, so that they don't just get, smashed with a huge 1-year elevated tax. That's perhaps a way that they can play a little bit with their income in retirement by having it kind of portioned out over a long stretch of time, maybe 10 or 15-year buyout. That would be a long one, but just to show you how you could reduce that average income down a little further. And then perhaps that's a way to keep them in the lower brackets and not have all that Social Security tax. That's one idea, one thing that a lot of entrepreneurs have to think about. Another is consider deferring your Social Security benefits. Remember, at age 62, we're eligible to collect. All right. For most people retiring now, the normal retirement age would be 67. All right. Between 62 and 67, if you're still working, depending on your income and a number of other factors, you may not be entitled to your full benefit. But more importantly, from a tax standpoint, if I still have earned income and I collect Social Security, that's probably going to put me in an otherwise higher bracket. And now I'll watch even more of my Social Security get taxed. So what some could consider doing is deferring their benefit to whenever they retire, maybe 66, 67, or maybe all the way out to age 70. All right. So that if essentially they've retired, they no longer have that big earned income and they're receiving now a lower income through whatever it might be, pension payments or what have you, plus then their Social Security payment. Another idea, this is a popular one available to a lot of people out there, very popular, it's very useful, okay? There's a reason for it, and that is using Roth accounts, okay? This could be Roth IRAs, it could be contributions through work through a Roth 401k or Roth 403b, it could be even through Roth conversions. Remember, the way that Roth accounts work is you pay the tax today, you swallow your medicine today, and then once the money grows in there, it can grow tax-free and be distributed tax-free as long as it's a qualified distribution, okay? So that's great because that is money that can be distributed and it is not raising our taxable income. So that is where we can get retirement distributions that don't mess up that combined income number so we can still live and enjoy ourselves and maintain the lifestyle, but essentially on paper, if you will, look like our income's not that high. So we can still have much of our Social Security benefits not be subject to tax, okay? Popular thing when people kind of have that corridor between when they retire and begin collecting, maybe they have a few years there at 65, 66, where they're in a lower income environment than they're used to. Those often are ideal years to consider a Roth conversion, okay? Because we're in lower tax brackets, maybe we convert some of our pre-tax retirement money over to Roth, and then that gives us a lot of flexibility later on. This is what we call tax arbitrage, all right? It's a method that when you're in retirement, year to year, you can select which buckets you want to access, so you can essentially manipulate your taxable income. All right, you could say, I'll take a little bit from my IRA, a little from my Roth IRA, a little from my joint investment account. And then this way, we're not sending our taxable income through the roof each year. All different methods. I'm really summarizing here, but certainly food for thought. All right. So in that same vein, you could be using non-retirement assets. Could be those taxable investment accounts. Another common play in retirement is for people who have permanent life insurance. They could start leveraging some of the cash value in there to generate income streams that are not subject to tax. Different methods of doing that. That might be a separate episode, but a common strategy as well. And then, of course, you just want to be a conscious investor. You want to be aware of, as I'm buying and selling, or my advisor, am I being subject to capital gains tax? If I am, hopefully those are long-term capital gains taxes. All right. Those are investments held at least over 12 months, as opposed to short-term capital gains, which simply get added to your income. All right. So this is now, as an investor for non-retirement money, you've got to be careful about this stuff. You have to get familiar, or your tax and your investment team, with tax loss harvesting, other strategies that can certainly help you in retirement. And then one more I'll just throw out there. Again, another popular strategy for those who particularly are charitably inclined. You can do what's called a QCD, or a qualified charitable contribution. What this would be is a donation to a charity that comes directly from your IRA or your retirement account. Okay, so you don't take ownership of that. You don't distribute it to yourself, put it in the bank and show taxable income, and then make a contribution that you would deduct, okay, for a charity. It goes directly from the retirement account to the charity, okay? And that can be a method where you can be satisfying your RMDs, other things like that, and not being subject to extra income tax. So I know I threw a number of things out there. If you just want to rewind 5 minutes and listen to those one more, perhaps those will sink in. But this is food for thought, guys. There's a lot of strategies you can use both in retirement and then certainly beforehand to put yourself in a position so you say, I'm going to get the best Social Security payment I can, and I'm going to pay the least amount of tax on it I can, because I've planned ahead and I've used these strategies. All right, so in closing, Social Security, huge system. America counts on it for retirement in particular, but the future is uncertain. Time will tell. It looks very different than it did, obviously, in 1940. It's projected to look in 1935 very different than it does today. So we're going to see how this gets handled by our elected officials, by all the economic folks out there. Time will tell, but in the interim, all that we can do is the best we can do with what we know right now. So I hope this put you in the know just a little bit more, maybe some things that you could think about for yourself or with your team. And I would just like to reiterate that I got to put my disclaimer in here. Of course, this episode is intended for the general public to potentially assist in planning for the future. This should not be considered investment advice, and listeners should consult their own financial professionals, legal, and tax advisors to discuss their specific situation. Had to throw that in there. So everyone, thank you very much for listening to this episode of the Kuderna podcast. Again, I'm Bryan Kuderna. If you have questions, if you have different topics, comments, whatever it might be, please follow us on social media. And you can always email the Kuderna podcast at gmail.com. And I'll do my best to keep everything, all the input in mind, so that we can get better and better episodes ahead of us. Again, like, subscribe, review, all that stuff. It's so appreciated. And thank you again for tuning in. We will see you next time.
This podcast is intended for the general public and for informational purposes only. The show does not provide any recommendations or investment advice regarding any specific account type, service, strategy, or product, or to otherwise act in any fiduciary or other capacity. Please contact a financial professional for guidance and information that is specific to your situation. Bryan Kuderna does not provide tax or legal advice. Please contact your accountant or legal advisor to discuss your situation. Guest speakers and their firms are not affiliated with or endorsed by Park Avenue Securities, Guardian, or Kuderna Financial Team, and opinions stated are their own. All investments contain risk and may lose value. Past performance is not a guarantee of future results. References to specific securities, asset classes, and financial markets are for illustrative purposes only and do not constitute a solicitation, offer, or recommendation to purchase or sell a security. Bryan Kuderna is a registered representative and financial advisor of Park Avenue Securities, LLC, PAS, OSJ 300 Broadacres Drive, Suite 175, Bloomfield, New Jersey, 07003. Phone number 973-244-4420. Securities products and advisory services offered through PAS, member FINRA SIPC. Financial representative of the Guardian Life Insurance Company of America, Guardian, New York, New York. PAS is a wholly owned subsidiary of Guardian. Kuderna Financial Team is not an affiliate or subsidiary of PAS or Guardian. California Insurance License Number 0K04194.